Why did asset allocation models get so complex? Imagine trying to balance a scale with many moving parts. That's what managing investments for seniors has become over time. It all started with simple ideas like putting 60% in stocks and 40% in bonds. This approach aimed to give steady income and some growth, perfect for seniors who wanted stability. But as markets grew more connected and investor goals changed, this simple mix started to fall short. The core idea behind asset allocation is diversification. It means spreading investments across different types of assets so that, if one drops, others can help keep your portfolio steady. Early models used basic math to find the best mix, considering expected returns and risks. These models, called mean variance optimization, were a big step forward. But they had problems. They relied heavily on estimates that could be wrong, making the suggested portfolios unstable or not very practical. To fix these issues, newer models added more layers. They looked at risks beyond just variance, like the chance of big losses in bad times. Investors also wanted to include assets like real estate, private equity, and hedge funds. These offer different risk and return patterns but are harder to value and less liquid. Models also started to consider how assets move together during market stress, which can change suddenly. This is called dynamic correlation. Technology played a big role too. Better computers and more data meant models could analyze many more factors. They used machine learning and scenario testing to see how portfolios might perform in different market conditions. This made the models more tailored but also more complicated to understand and manage. For seniors, this complexity can be a double-edged sword. On one side, it helps create portfolios that better manage risk and provide steady income. On the other side, it can make investments harder to understand and more expensive because of higher fees and trading costs. Many seniors work with financial advisors who use these advanced models but explain them in simple terms. They focus on diversification across traditional assets like stocks and bonds, and sometimes include alternatives like real estate or commodities. The goal is to keep things straightforward while still benefiting from smarter risk management. In the end, asset allocation models got more complex because markets and investor needs did. They now include more asset classes, consider changing relationships between assets, and use powerful technology. For seniors, understanding this helps in choosing investment strategies that balance growth, income, and simplicity.